Look no further than industrials, though. I do that because Kevin bought more Caterpillar, which I want to hear about. Why now for an industrial name like this?
It's surprising that you see industrials perform as well as they have this year, surpassing my expectations, certainly. But I look at Caterpillar as almost like a stealthy play within the data center space because you need the industrials, Caterpillar specifically, to do this type of heavy construction. It's trading at only a 17 PE, 25% discount to John Deere, which is pretty historically wide for those two names, 2% dividend, and lots of free cash flow. I think this is a name that's going to perform really well for the next few years.
You own it too?
Yeah, we like it. I think industrials broadly, if you look at Caterpillar itself, that's right in the mix of one of the largest names in the space. But it's been very secular across the space: defense, energy production, energy grid storage, data center build-outs, potential reshoring. There's a lot of tailwinds within here, and not only that, it's all happening in industrials with manufacturing PMIs in contraction territory. So this is maybe a bigger, longer-term bottom here in industrials that could see larger tailwinds as things build.
Kev, Honeywell today, price target, speaking of industrials, 258 from 243, overweight at Barclays. You own that stock too.
Yeah, I like the price hike. I think the sum of the parts is going to be far greater when they break this company up. Now, you have some time to get into it. This isn't imminent. It's not going to happen tomorrow. I think of this as like one of Steve Weiss's perpetual compounders, and I think it's a name you can own long term.
Yeah, Rollins, buy at Argus, $68, Joe, is the price target, which you own that name too.
Pest Control, great example of a mid-cap company that right now is in the sweet spot, as are some of these other industrial names. The industrial sector itself, look, you've got Uber in there. We always talk about that. You have Axon. Those are, to Steve's point, clear momentum winners, and there's also earning strength visible as it relates to Uber. But there's names we don't talk about a lot that are performing remarkably well. We talk about how the ITA, the aerospace and defense ETF, is doing well. Well, it's not so much the defense names that are doing well. It's the aerospace names. It is Howmet, which is doing well. It's Hyco. It's Republic Services. It's Rollins. It's Cintas. So I think the industrial sector so far is capturing a lot of capital that over the last several years has found this sector unappealing. Now that you have the earnings growth visibility, there's a lot of room to rebuild positioning in a multitude of these names, and it's represented in the performance.
What do you do, Weiss, if you think like you do that maybe we're going to still have that slowdown in the economy as a result of the tariffs and some other issues with, I mean, you own Caterpillar as well, with the industrial space?
Yeah, so I own Caterpillar. I also own the XLI, which gives me the exposure, as Joe mentioned, to aerospace and to defense. So to me, that's a great holding. Now, I did it in case I'm wrong, frankly. If I'm right on the economy, and I agree with Steve, even though he didn't make a prediction, he pointed out stagflation is the conversation. I've been saying that for a couple of months now. Then I'll be wrong, Caterpillar, and I'll be wrong in the XLI, candidly. But if I'm wrong on what the economy is doing, and I'm wrong on how investors regard the economy and this resilience has no end to it, then I want to participate through Caterpillar. And my preference was Deere, but to Kevin's point, Deere was trading at too high a level, and disparity and the width of the discount from Caterpillar to Deere drove me to Caterpillar. I also believe that you buy the tool belt, which is another reason, so I agree with Kevin on that, in terms of data centers. Data centers themselves, the cap rates are too low, and I think there's going to be some overcrowding in the data center build, but that'll be good for CAT. So that's why I own it. Fundamentally, I think it's working well.
We pay attention today to what interest rates are going to do, and then see what growth stocks do. NASDAQ's been great, as you know. It's green today. It's up 10% over the last 12 months. Year to date, 1 2/3%, but it's really carried stocks back. I bring it up because we have moves. Jabil, Kevin Simpson, your newest move. That's a fresh buy.
It is, Scott. We made this our final trade on Thursday, bought it on Friday. It's up $20 since then, if you can believe that. Now, this is in our growth portfolio. We bought it before earnings. Earnings were great. They beat on the top line. They beat on the bottom line. 16% year-over-year revenue jump. But what I liked most about the earnings report was that management increased the year-over-year top line, bottom line. They're not taking away earnings. They're not downplaying them. They're increasing them. That's a stock you probably want to own. It's up a lot, so be careful.
Yeah, but a lot of people on the street like it. So price target raises, 4 of them in front of me. Ray J to 230, Barclays to 223, Goldman to 215, and JP Morgan at 214. So what looks like a pretty good chart, they think is going to look even better. You sold a covered call on Apple, the worst performing Mag 7 stock year to date.
Yeah, Steve, what you do if you go into a range-bound market, and we believe, fervently in hedging positions that aren't doing a whole heck of a lot. Apple being a great example. About 11 days ago, we sold a covered call, brought a few dollars in, bought that back yesterday, basically for nothing. Wrote another call expiring out another week and a half. When you total it all up, if we collect all the premium, which I think we will, we'd effectively be out at 206.10 if we get called away. And if not, we brought in $5 of premium literally in 3 weeks.